Hi everyone, I'm Connor Kitko and you're watching What's Trending on YCharts. Every month we pull back the cover to show you the stocks, mutual funds, ETFs, and econ data that people are searching for on the internet and YCharts to help you make smarter investment decisions. Today we're going to be talking about the crazy year for Twitter even before the news from Elon Musk. We'll also talk about floating rate bond ETFs and how they're well suited for this rising rate environment. And we'll close it out with a discussion of the recent news from the Fed board raising rates by 0.5%. If you have any questions about this data or the stories we're discussing, check out the description below. And now let's see what's trending. All right, starting off with the most popular company and stock data on YCharts. Nothing really surprising here. Lots of people have been looking at Tesla, Apple, Netflix, Amazon, Meta Platforms, Microsoft, and Alphabet. Most of these names are down worse than the overall market to start 2022. And here's just how bad they're down. Some key takeaways from this chart. Apple, which is our orange line, has been holding up the best of these mega cap names. Tesla, the purple series, has been the most volatile overall with significant drawdowns throughout 2021 and now to start 22. And then Netflix there in blue, more than 70% off of its recent all-time high, but it is a much smaller stock than the others on this chart and thus probably not as big of a lever for those market cap weighted ETFs and mutual funds. And YCharts just released some awesome research on this exact topic, showing the extent to which these names are driving performance and risks in most of our portfolios. Check out the description below for a link to download that white paper. Now let's turn to the hottest company pages over the last month, those with the highest month-over-month page view growth. Topping the list are Tencent Music Entertainment, not to be confused with Tencent Holdings. Lots of Twitter pages here, including shares outstanding, PE ratio, and market cap. We also see Spotify and then a few Netflix pages, including PE ratio, their income statement, stock buybacks, all trending after Netflix's subscriber base shrunk for the first time on record this last quarter. So let's zero in on Elon Musk's favorite new toy, Twitter. Obviously, the big news for Twitter these days is that buyout from Elon Musk. But since the start of 2021, Twitter has set a new all-time high share price, then drawn down 30%. Then they announced a $4 billion buyback plan and drew down a further 50%, accelerated the first of that $2 billion of repurchases. That's the blue line on our chart here. And then finally became an acquisition target for Elon Musk. And the share price is basically right back to where it started at 2021. So was all of this for nothing? Turning to the most popular mutual funds and ETFs, it's a who's who of the largest passive ETFs out there, like SPY, the Qs, VOO, and IWM. On the fixed income side, we see AG and BNDX. And finally, ARK, the lone active ETF on our most popular list. And because this gives us a pretty good lineup of different asset classes, let's compare their performance year to date. Here we have a scatter plot of all those ETFs. On the x-axis is max drawdown over the last year. On the y-axis, year-to-date performance in 2022. AGG, representing US bonds, and BNDX, representing international bonds, have held up the best so far, whereas SPY, QQQ, and the small cap Russell 2000 are slightly worse off year to date. And that blue dot in the bottom right corner is ARK. Unfortunately, max drawdown worse than 60% over the last year, and a year-to-date total return of negative 47%. So clearly, not a great start to the year for anyone. Looking at our most popular mutual fund and ETF pages, highest month-over-month page view growth, let's tease out a few patterns quickly. Some money market funds from the likes of BNY Mellon, Fidelity, and Vanguard. Money market mutual funds saw a huge influx of assets in 2021, but a lot of that money has left for relatively riskier asset classes like equities to start 22. Then a couple sector ETFs, XLP and XLV, targeting consumer staples and healthcare respectively. And rounding out the list are fixed income funds like alpha-centric income opportunities, SHI, a short rate bond ETF, and finally, the fund that we're going to focus on today, the Catalyst CIFC Floating Rate Income Fund. And here's a look at why this one's so interesting. We have that floating rate fund in purple, and we're pitting it against some other major bond categories like US aggregate bonds in orange, investment grade corporate bonds in blue, munis are here in green, and our short-term treasuries ETF is in pink. And this clearly shows why floating rate bonds or bank loan ETFs are so popular right now. As interest rates begin to rise, prices of fixed income ETFs tend to suffer. However, floating rate bonds are uniquely positioned to maintain their yield spreads even as rates are rising, and that's why they're gaining a lot of attention from investors. All right, moving on to the most popular econ data on YCharts. Topping our list of most popular, 10-year treasury rate, followed by the 5-year, 3-year, 2-year, and 3-month rates. We also see that 10-to-2 spread, which briefly inverted to start off April. Mortgage rates, inflation, retail gas prices, and the CBOE equity put-to-call ratio round out this list. Taking a look at that interest rate picture, in the bottom panel, you can see how that 10-to-2 yield spread did briefly invert, but it's worked its way back into positive territory. And the Fed just announced a 0.5% rate hike, which is a little unusual compared to the usual 25 basis point moves that they make. And the market initially responded very positively. A day later, not so positively. Apparently, it's being called into question whether the Fed truly can tamper inflation without stocks and the economy paying the price. As a reminder, we have seen one quarter of negative GDP growth, and 2 quarters by definition is a recession. Closing things out, the hottest econ data pages on YCharts. More interest rates, very exciting. We see, in addition to the 10-year, some shorter term yields also caught interest, like the 1-month, 3-month, and 6-month rates. We also see the 4-week treasury rate, which is apparently different from the 1-month, something I learned today. And what I'd like to focus on here is that S&P 500 PE ratio. This has been one of the biggest and more interesting trends post-COVID-19, the contraction and then rapid expansion of corporate earnings as prices were going higher. So as shown by the purple and orange lines on this chart, which are the S&P 500 total return and its PE ratio respectively, and then that blue line, which continues into the future, represents a forward estimate of the market's PE ratio. And let's talk about the 2 levers of PE. Pretty obviously, they are prices and earnings per share. When valuations rise or fall, it's because one or both of these metrics is moving, but it is important to know which. In 2021, the S&P continued higher rapidly, and its PE ratio only came back down once that earnings growth started to catch up with the market prices. But to start 2022, stock prices are falling rapidly, so the question is, we see this forward estimate of PE continuing to decline. Will it be because prices continue to crater, or will it be because earnings growth continues to be strong? Remains to be seen through the end of the year. We hope you enjoyed this latest episode of What's Trending on YCharts. We talked about how Elon's buyout was just the latest in a crazy year for Twitter. We talked about how floating rate bond ETFs might be a great option in this rising rate environment. And finally, how the recent Fed rate hike will hopefully tamper inflation without snuffing out corporate earnings growth. Subscribe below to catch the next What's Trending. We'll see you then.